In December last year, the Canadian Securities Administrators announced that in most provinces, the use of deferred sales charges, or DSCs, will be banned in 2020. We say most provinces because the OSC will not be banning the DSC option after the Ontario government opposed the ban. Here at Morningstar, we've talked about this decision a lot. We believe DSCs are not in the interest of investors and should be banned. The OSC has decided to walk a path between banning and freely allowing DSCs by restricting these expensive products. It's a compromise. Dan Hallett, VP and Principal at HighView Financial Group, is here with us today to discuss these restrictions. Dan, thank you so much for being here today.
Yeah, it's a pleasure.
All in all, with these restrictions, is the OSC making the best of a bad situation?
Well, they are. I mean, as you pointed out, I think it was Ontario's preference and really all the other regulators to do an outright ban. I think it is the best they can do because ultimately they think if they thought the best way to protect investors was a ban, and that's not possible, at least these restrictions will minimize the harm that can be done to investors.
Are these restrictions enough? Is there anything else that the OSC can do to protect investors from these predatory products?
You know, I think they've covered all of the big issues. I think there are certainly a couple of smaller things they can do. But they've really covered things off. So some of the additional suggestions, either that we're going to add into our submission, or I've seen from others, things like trying to protect vulnerable clients. Now, the measures they've proposed do that to an extent, and I've seen at least one suggestion that potentially can add some good protections for other vulnerable people that aren't covered. And then, the other thing is they could put things like a maximum commission percentage rate on there as well. So there are little tweaks they can do, but I think the OSC has really covered things off pretty well in its proposals.
You've said before that the decision to not ban DSCs by Ontario was more political than investor safety driven. With that backdrop, do you think that these restrictions will pass without opposition?
I suspect they will. I mean, you never really know. The finance minister we had when this was first rejected is no longer the finance minister. However, they've remained fairly consistent. But I suspect the Ontario Securities Commission would not have put the work into this and started another consultation if they weren't pretty confident that this would pass. Because ultimately, it kind of gives the industry what it wanted, which was avoiding an outright ban. For them, for the industry, it's probably a compromise because they lose the full DSC if everything gets implemented as proposed. But yeah, I suspect that it will be accepted by the government.
The OSC has divided the restrictions into two: fund manager restrictions and dealer restrictions. Let's start with the fund manager ones. What do these restrictions mean for investors?
Well, in a nutshell, and maybe it's good context just to quickly go over what the status quo of the deferred sales charge is. Essentially, an investor will purchase a fund. That triggers an upfront commission of 4 to 5% to the dealer, which is split with the advisor. And they're typically in that fund for 6 to 7 years. And if they sell out of the fund entirely, out of the fund family entirely, within that 6-7 year period, they're hit with an exit fee that declines over time. And so ultimately what this will do, if these proposals are passed, the upfront commission will be less. It will restrict. It'll just protect more people in terms of being exposed to DSC, because it won't be permitted to be used for nearly as many people as it has in the past, and it'll keep people locked in for a shorter period. So, it's kind of a watered down version of what exists today, but it's better than the status quo.
Now let's discuss the dealer restrictions. You've said that the restriction on the use of borrowed money to buy DSCs was one of the best measures. Why is that?
It's really because of the big conflict of interest that's inherent in that. And I think even the rationale that's in the consultation paper doesn't touch on that, although I know the OSC is well aware of it. What I've seen in the past over my career, it wouldn't be uncommon to see, for the advisors that are real advocates of leverage, to see them recommend clients taking out a fairly substantial loan, up to, often in the six figures, not uncommon to see 300,000 to 500,000, and all of that being invested in a lump sum in one or more DSC funds. So that triggers a fairly hefty upfront commission. And, you're involving, so you're generating that commission by having the client take on a significant amount of risk. And the conflict it just screams conflict of interest. So to the extent that that can be really regulated regulated into extinction, then I think that's a good thing. And probably one of the bigger, if not the biggest conflict that I can think of with respect to deferred sales charges.
There are also restrictions on commissions and redemption fees. What do you make of those?
So, those are on the commission and redemption fees. Really it will limit the level of fees that people will see if they do sell out within the 3 years versus the current 6 or 7 year period. So even if they do trigger an exit fee by leaving early, they won't pay nearly as much. And then the upfront commission, according to the consultation paper, is really only limited by the account size. So the OSC is proposing no more than $50,000 in terms of an account that can be invested on a DSC basis. And so that will limit the commission. Our suggestion, as I noted, will also apply a maximum commission rate, because in theory, even if it's limited to 50% or 50,000 rather, in theory, there's no limit to the commission rate that could be applied to that. Economically, there'd be a limit because it can't go to the sky, but I think imposing that percentage rate as well and codifying that, I think will help.
Finally, as investors, how should we protect ourselves from these products?
Well, it's a tough thing. It's a tough question to answer, because ultimately it involves people being informed. But I think it just comes back to that. For those who may not be either as interested or have the inclination or really know where to look to get informed, at the very least, I would say people should follow their gut and just ask questions, even if you think they're quote unquote dumb questions or naive. Because if something just doesn't feel right, or if you don't feel you know enough, I think you just need to ask. Nobody works for free. In very rare circumstances, unless they're doing you a favor. But for the most part, you have to know that if you're engaging someone to provide a service, they're going to be paid somehow. And if it's not clear to you how they're being compensated, you need to ask about it until you get an answer that sounds and feels right to you. The ideal, of course, is that you do a lot of reading and inform yourself, and you kind of know, you can kind of confirm those things. But for a lot of people, that's not going to be possible. And so it really is going with your gut instinct and making sure to understand, what you're being provided in terms of a service, but also how that person across the table for you is being compensated.
Thank you so much for being here today, Dan.
No, you're welcome.
For Morningstar, I'm Ruth Saldana.